or wherever you are, and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets. And this is with a view to helping you better understand how the markets operate so that you can make informed investment decisions. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 198, and in this episode we're reviewing the performance of the financial markets during the fifth week of 2026, and that is from Monday the 2nd to Friday the 6th of February. And without further ado, this is your host, Jamuhuri, and together, let's dive right in. We kick it off in the United States, where on Wednesday, the Bureau of Labor Statistics announced that the January jobs report, which was supposed to be released on Friday, had been delayed by the brief government shutdown earlier in the week and will now be released this coming week on Wednesday, the 11th of February. Economists surveyed by Dow Jones expect the Nonfarm payrolls report to show a gain of 60,000 jobs for the month of January, following an increase of 50,000 jobs in December. The report is also projected to show that the unemployment rate held steady at 4.4%. Earlier in the week on Wednesday, payrolls processing company ADP reported that private companies added about 22,000 jobs in the month of January. Moving over to the Eurozone, where flash data from statistics agency Eurostat showed that Eurozone inflation cooled down to 1.7% in the month of January. Economists polled by Reuters had correctly projected that inflation would decline from 2% in December 2025 down to 1.7% in January 2026. Meanwhile, core inflation, which excludes volatile food and energy prices, this came out at 2.2% in January, down slightly from 2.3%, which was recorded in December last year. This latest data shows that inflation has now dipped below the European Central Bank's target rate of 2%, suggesting that the central bank is likely to keep its policy rate on hold for the foreseeable future. Staying in the Eurozone, on Thursday, the European Central Bank decided to keep its policy rate on hold for the fifth consecutive meeting, maintaining its benchmark policy rate at 2%. Following the decision, the ECB noted that the inflation trajectory and wider economic conditions did not warrant a change in policy this time around, but warned that the outlook was unpredictable. The ECB expects inflation to stabilize at around 2% in the medium term as the Eurozone economy remains resilient against a backdrop of a challenging global environment. At the same time, economic outlook remains uncertain, owing in particular to the ever-changing global trade policies and geopolitical tensions. On the European currency, over the past 12 months, the euro has appreciated almost 14% against the US dollar, and this is on the back of rising concerns over the unpredictability of US economic policy. Some ECB policymakers have expressed concern over the single currency's appreciation against the greenback and its possible effect on the bank's inflation target of 2%. Currency appreciation tends to cause disinflation by making imported goods, raw materials, and energy cheaper, and this in turn lowers production costs and consumer prices. While that may be good for businesses and consumers in the short term, central banks are concerned about disinflation and potentially deflation over the longer term because it can trigger economic stagnation with consumers holding off purchases in the expectation that prices will fall further, which leads to lower revenues for businesses. Over to the United Kingdom. On Thursday, the Bank of England decided to keep interest rates on hold at 3.75% during its first policy meeting of 2026. The central bank's 9-member Monetary Policy Committee voted by a narrow margin of 5-4 to keep interest rates on hold. 5 members of the committee voted to hold the policy rate, whilst the other 4 members voted to reduce the bank rate by 25 basis points. The central bank said that monetary policy was being set to ensure that inflation not only reaches its target rate of 2%, but remains sustainably at that level in the medium term. On the basis of the current evidence, the committee said that the bank rate is likely to be reduced further. However, the extent and the timing of further easing of monetary policy will depend on the outlook for inflation, although it added that it expected inflation to fall back to around its 2% target rate from April this year. On Wall Street this past week, the outlook was bleak heading into Friday, with the S&P 500 on track for its worst week since October and the Nasdaq Composite on track for its worst week since the market plunge in April 2025. However, the stock market recovered significantly later in the session, with the Dow Jones exceeding the 50,000 level for the first time in its history, driven by technology stocks that recovered following several days of heavy selling in the tech sector. According to market analysts, the stock market benefited from some rotation into cyclical stocks, even as the overall market was weighed down by the tech sector. The Dow Jones Industrial Average advanced by 1,206 points on Friday and was up by 2.5% for the week before coming to a close at 50,115. Meanwhile, the S&P 500 jumped 1.9% on Friday, but still posted a weekly decline of 0.1% before closing the session at 6,932. And the tech-heavy Nasdaq Composite advanced by 2.1% on Friday, but still recorded a weekly loss of 1.8% as it eventually came to a close at 23,031. In the government bond market, U.S. Treasury yields remained relatively unchanged on Friday as investors continued to assess the state of the U.S. economy. Consumer sentiment, as measured by the University of Michigan, showed some improvement on Friday. However, the ADP private payrolls report came out weaker than expected as the release of Nonfarm payrolls report for January, which was due out on Friday, was delayed until Wednesday this coming week due to the brief government shutdown that happened earlier in the week. The yield on the short-dated 2-year Treasury note rose by more than 1 basis point to settle at 3.49%, whilst the yield on the benchmark 10-year Treasury bond was down by less than 1 basis point as it came to a close at 4.20%. For your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, the price of crude oil held steady on Friday as Iran and the United States held negotiations to try and overcome sharp differences over Tehran's nuclear program. Ahead of the talks, a lack of consensus on the agenda for the meeting kept investors anxious about an escalation in geopolitical tensions. Any escalation of tensions between the two nations could disrupt the flow of oil through the Strait of Hormuz, where about 20% of the world's total oil consumption passes through. The price of the global benchmark Brent crude rose by 50 cents to close at $68.05 a barrel, whilst the price of the U.S. benchmark, that is West Texas Intermediate crude, gained by 26 cents to settle at $63.55 per barrel. In the precious metals market, the price of gold rebounded on Friday and was on track for a weekly gain, helped by a slightly weaker dollar and lingering concerns over the talks between the United States and Iran. Analysts, however, say that the current rebound in gold did not have sufficient momentum to break into a new record high. However, an escalation in geopolitical tensions could trigger gold towards $5,000 per ounce. The precious yellow metal was headed for a weekly gain of about 2% as the price of spot gold eventually settled at $4,954 per ounce. Meanwhile, the price of spot silver was headed for a weekly loss of about 8.7% before coming to a close at $77.33 per ounce. In the cryptocurrency market, just one day after almost falling below $60,000, Bitcoin staged a stunning rebound on Friday as it broke above $70,000 per coin. The stunning rebound came after Bitcoin plunged more than 15% on Thursday before finally finding some support at around $60,000. The rebound in crypto came as stocks also recovered on Friday as investors rotated back into risk-on assets, driving the surge in stocks, and this was on the back of fading fears over the threats posed by artificial intelligence to software companies. Bitcoin has declined by more than 45% from its all-time high of $126,000 that was hit in October 2025, and the flagship cryptocurrency rose more than 11% on Friday and was last seen hovering around $70,000 per coin. We now change scene to the Kenyan financial markets. And as is the norm, we start by looking at the domestic foreign exchange market, where the Kenya shilling continued to trade sideways versus the US dollar. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.02. Meanwhile, the sterling pound was priced at 175.77 and the euro was valued at 152.09. And on the regional front, one Kenya shilling was changing hands for 27.59 Ugandan shillings and 19.91 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.27. The IMF has previously raised concerns about the extreme stability of the Kenyan shilling, but the central bank insists that it continues to operate a floating exchange rate policy. However, the data tells a different story, as the dollar shilling rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 60% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves increased by $53 million for a grand total of $12.38 billion, which is equivalent to 5.3 months of import cover. This level of reserves is in line with the central bank's statutory requirement, which is to endeavor to maintain at least 4 months of import cover. Despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market remained sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya shilling overnight interbank average, aka Kesonia, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate surprisingly shot up to 9.99% on Thursday, but still averaged at around 9.19 for the week, which is in sync with the central bank rate at 9% flat. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is currently set at 3.25%, this averaged at around 8.9 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 5th of February, and the central bank received bids totaling to 64.2 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of 267%. The central bank ended up accepting about 50 billion shillings, and the results of the auction were as follows. The 91-day rate was relatively stable at 7.62%, whilst the 182-day rate dipped by about 1 basis point to perch at 7.78%, and the 364-day rate was marginally lower at 9.19%. At the Nairobi Securities Exchange, during the week, the equities market was on an upward trajectory, with the NASI gaining the most by 3.8%, whilst the NSE 20 gained the least by just 1.5%. This takes a year-to-date performance to gains of 8.2% for the NASI and 6% for the NSE 10. The market's performance was mainly driven by gains recorded by large-cap stocks such as Safaricom, which increased by 8.1%, whilst the British American Tobacco and DTB Bank rose by 5.6% and 5% respectively. This performance was, however, weighed down by losses recorded by other large-cap stocks such as East African Breweries and NCBA Bank, which declined by 3.3% and 0.3% respectively. Up next is our topical issue, and this week we are looking at two topical issues, and the first is on Absa Bank being on the lookout for a deal in the retail banking sector. South Africa's Absa Bank is exploring plans to buy another Kenyan bank in a move that would help it grow its market share in the retail banking sector. The bank is actively looking at several acquisition options with the view to expanding its lending capacity as it seeks to reclaim its previous position as the number one bank in Kenya. The Absa Group CEO, Kenny Filler, told the Business Daily that they were always on the lookout for opportunity in the Kenyan market, as he noted that the regulatory environment in Kenya and the wider East African market was conducive and positive for inorganic growth. And on the second topical issue for this week, we're looking at Safaricom's approval of a higher interim dividend for the financial year 2026. Safaricom has announced an interim dividend of 85 cents per ordinary share for the financial year ending the 31st of March 2026, marking a sharp increase from last year's payout of 55 cents. The company's board approved the dividend at a meeting held on Wednesday, the 4th of February, and the interim dividend will be payable to shareholders on the register of members as at the close of business on Wednesday, the 25th of February, and will be paid out on or about the 31st of March. The interim dividend represents a year-on-year increase of 54.5% and reflects a strong half-year performance. With about 40 billion issued shares, this interim dividend will see Safaricom distribute more than 34 billion shillings to shareholders, with the government taking in about 11.9 billion shillings for its 35% stake in the company. The dividend announcement comes as the Kenyan government is considering selling a 15% stake in the company to Vodacom Group, a proposal that is currently under parliamentary review. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhuri@gmail.com. Jamuhuri spelled JAMUHURI. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, success is a few simple disciplines practiced every day. A quote by Jim Rohn. Think about it. Thank you, and God bless.